Most people focus on portfolio returns as the ultimate indicator of financial success, but you should be focusing on your savings rate instead. In this video, I'm going to show you how to calculate your savings rate, how to determine how much you need to save, and how to get started. Your savings rate is one of the few variables that you actually have some control over when it comes to building your wealth, and it's one of the most impactful ones as well. To calculate your savings rate, just take the amount you're saving annually and divide it by your total income. Make sure you account for all your savings, RSPs, TFSAs, retained earnings in your corporation, and divide it by your total income. So if you're incorporated, use your corporate income, not the salary and dividends that you're paying to yourself. You can use a pre-tax amount or a post-tax amount. It doesn't particularly matter. What matters is that if you're measuring this over time, just make sure you're using the same calculation each time. You also want to track this separately for different goals. If you're saving for retirement and you're saving for your kids' education, you'll want to separate those out. So let's say you're saving $10,000 per year to your kids' education and you're also saving $10,000 per year to your RSPs. Well, your savings rate for each of those goals is going to be the same when you divide it by your total income, but your retirement capital needs to be significantly higher in order to fund your retirement goal. So keep track of them separately. So once you've calculated your savings rate, you need to match that against your required savings rate. Your required savings rate is really just the amount you need to save in order to meet your goals. You can't really figure this out with one tidy formula, but there are a few ways to figure it out. If you're working with an advisor or a financial planner, they should be able to help you sort it out. If not, there's dozens, if not hundreds of online calculators that you can use. Just Google retirement savings calculator. All the banks have one, most investment firms have one. They're all pretty similar, but find one that works for you because some have different variables missing. So just find one that you can use relatively easily. We're not trying to get really granular on this. We're just trying to put a peg in the ground. We're trying to create a target to aim for. When you're going through the calculator, you'll have to account for a number of variables, things like inflation rates in the future, portfolio returns. I suggest you try to be very conservative with these numbers. You're not trying to build a best case scenario. What you're trying to do is make sure using conservative assumptions that you're actually on track. So if you're using a calculator that has the option for inflation, I would suggest between 2 and 2.5. That's Bank of Canada's target. I know inflation's been a lot higher lately, but longer term that should come back down. So err towards 2.5 if you're feeling a little bit uncomfortable with that. And when it comes to portfolio returns, I would use somewhere around 5%. You have to think of the portfolio returns as net of fees if you're paying any advisor fees or MERs inside your funds. So use conservative assumptions here. Some of the calculators you'll find online are more complex than others, so if you're using one that allows you to enter things like CPP and OAS in the future, government pensions, you can certainly do so. Again, be conservative if you don't know how much to expect from those. You can find all those numbers online as well, or just ignore them for now. Again, we're just trying to come up with a general plan, something to benchmark our savings against over a long period of time. So once you've gone through some of these calculators and figured out your annual savings rate, divide it into monthly or bi-weekly increments, whatever's easier for you. And if it's a really big number, don't feel that you need to start doing that immediately, right? If it's $10,000 a month, for example, don't try and start with $10,000 a month. Start with a small number and work up to it. It's much less of a shock to your budget and your spending patterns to start with a small number. Get comfortable with that, but just make sure you're aiming to increase it towards your target over time. The best part of doing it this way is that once you hit your savings target and you know you're on track, you can spend the rest guilt-free. You don't have to worry about itemized budgeting or accounting for individual expenses so much. Once you've paid your future self, you know you're on track, you don't have to feel bad about spending everything else. As I mentioned, start small if that's easier for you. I know a lot of people don't start saving earlier in their life because they feel that the amount that they can save is insignificant. Compounded over long periods of time, no amount is insignificant, right? These days, some online brokers let you buy fractional ETF shares, meaning that you can set up an index portfolio with as little as $1. A lot of mutual fund purchases have minimums of only $25 per transaction, so no amount is insignificant. Start small, build it up over time. Don't fall into the I'll save what's left over trap. If you're like most people, there won't be anything left over before your next paycheck. It's really easy to spend the money that you see in your bank account, right? We call this lifestyle creep. If there's money available, it's fairly easy to spend. So make sure you're paying yourself first. In the words of Warren Buffett, do not save what is left after spending, spend what is left after saving. The other benefit of automating this and starting small is that it becomes a bit of a positive feedback loop. $25 a month or $50 a month might seem insignificant when you get started, but over time that amount grows and grows and grows, and as you see the balance growing, it introduces this sort of feedback loop where it's exciting and it becomes, maybe not addicting, but encouraging. So it can be really, really motivating to see those balances grow over time. And what I find a lot of people will do is they'll then look for ways to increase that contribution, right? Savings this way and setting goals and achieving them actually activates the reward center of your brain. And so there's this sort of physiological component to saving and increasing your savings over time that can be really, really powerful. I like to call it behavioral compounding. I'm not sure if there's a more official term for it, but like I said, start small. Automate your savings as soon as possible, increase it over time, and you'll be ahead of 90% of people. So that's it really. Start small, start now, and review it over time to make sure you're on track. If you found this video helpful, please share it with your friends, family, and colleagues. And as always, if you want to discuss any of this further, please feel free to get in touch.